GDP figures are in, and the economy grew at 2.6%. Welcome to Weekend Bite, presented by Wall Street Breakfast. Commodities, like much of the broader market, have been whipsawing back and forth amid a ton of volatility, with energy, as most of us know, leading the way, up 60% year to date as of this morning. I'm Leslie Osmond, and joining us today is Andrew Hecht, a sought-after commodities and futures trader and top-ranked Seeking Alpha Marketplace author. Welcome, Andy.
Thank you so much, Leslie. It's a pleasure to be here with you.
Well, as I mentioned, GDP news this morning was both positive and above expectations, showing the economy grew at 2.6%, with the markets immediately anticipating that the Fed may be successful with a softer landing. Would you agree with the reaction of the commodities markets?
Well, I would have gotten that one wrong because I expected the third consecutive quarterly decline in GDP. So I think that kind of throws the Fed into a little bit of a tizzy here. Higher GDP and the latest inflation data. The market's going to expect them to raise by 75 basis points, but this week Canada raised only by 50, surprising the market. So I expect a lot of volatility going into this Fed meeting. I think that 50 basis points will be bullish for the overall stock market and bullish for commodities because it'll probably weigh on the dollar. But 75 might have the opposite effect. So we'll see what happens, how they interpret this GDP data. But with the midterms coming up, it's going to be very interesting.
And you like to focus a lot on commodities. What impact do you believe the Fed's decision and rate hikes have on commodities, particularly precious metals?
Well, look, the gold and silver, are very sensitive to the U.S. dollar and to interest rates. So the path of least resistance of the dollar index has been higher because of rising interest rates. So rising interest rates, a strong dollar weighs on gold and silver, and vice versa. But I think that the prices have done pretty well. While they've come off the highs from earlier this year, particularly gold came off a record high. The price is not that low compared to where it's been in history. We're still, we this century we've moved from basically $250 an ounce to almost $1,700 an ounce. Let me take a quick look where gold is. Yeah, 1666 this morning. Nothing really that special. I'm bullish on precious metals because I'm bearish on fiat currencies. The dollar index, in my opinion, is a mirage. And, government policies, central bank policies are just eroding the value of fiat money, which is bullish for these in the long term. By the way, every dip in gold for the last 23 years has been a buying opportunity.
Okay, well, looking at the current supply-demand dynamics and the future demand outlook, would you put your money in more precious metals then, or more hard metals? Why?
I like hard assets, Leslie. In general, I have my portfolio is extremely heavy in raw materials. I like energy very much, traditional energy. I like copper. It's one of my favorite plays right now because of the idiotic nature of traditional energy policy. We can talk about that a little bit, but I like commodities in general. I like the grains because of their relationship to energy and through biofuel, and because Europe's breadbasket is on fire here with the war in Ukraine.
And speaking of energy, as well as your recent article that you released on Tuesday, you discussed the long-term bullish trend that mentions copper as the new oil. Talk to us a little bit about why you like copper and its benefits and how it's affecting the Eurozone crisis as well.
Yeah, well, I can't take credit for calling copper the new oil. That was Goldman Sachs. They did that last year while copper was on its way to a high. It rose to 501 a pound. It's come off. It's down near 350 a pound. Look, copper is key in terms of EV production, in terms of wind turbines, and all these green initiatives. Which I think is very important because the supply is dwindling, and it takes a better part of a decade to bring new supplies online. LME stocks, which is the critical market for copper, have been, trending lower, and production can't keep up with demand. Now, I think that, it's all a bit of a fallacy. Copper is the greener path for energy. But the world still runs on oil, natural gas, coal. Environmentalists have a very large platform in the United States and in Europe. But the fact is that they can't do a hell of a lot about cleaning up the climate or the environment without the cooperation of China and India, who are two non-cooperative partners, basically. So the world continues to run on these traditional energies. And while copper, I'm very bullish on, I think we'll make new highs. I think Goldman's calling for it to go to $15,000 a ton, which equates to about $6.80 a pound on COMEX, which is almost double the current price right now. It's around $3.50. I'm also bullish on oil, natural gas, coal. I mean, look, U.S. energy policy basically handed control of the oil market pricing back to OPEC. I like to call them the criminals at OPEC and the Russians. And after years of suffering under shale production, rising shale production from the U.S., it's payback time for these guys. And they're basically going to, cut production as they did recently to keep the price above $80 and hopefully in their case above $100. And price spikes are definitely likely because of Russia's involvement with OPEC. They're the most influential non-cartel member in history. And production policy and pricing decisions are made in Moscow and Riyadh. And the bifurcation of the world, with China and Russia on one side, the U.S., Europe, and their allies on the other side, political divisions in the U.S. between environmentalists and non-environmentalists, it's all a mess, and it's all going to lead to volatility. So that's a very long answer to a very short question, Leslie.
Those are strong opinions. And speaking of strength, what impact is the strong dollar having on commodities in 2022? And do you believe a falling dollar may support international buying of commodities?
I do. And look, as I said briefly, the rising dollar, in my opinion, is a mirage because all fiat currencies are losing value. So the dollar is the world's reserve currency, which means that central banks around the world hold the dollar. But very interestingly, this bifurcation between the world's nuclear powers diminishes the dollar's role. Very recently, after, this year, after sanctions on Russia and Russian retaliation, the Russian government said that 5,000 rubles are exchangeable for 1 gram of gold. That's spitting in the face of the dollar as the world's reserve currency. Now, China is not Washington's best friend these days, and they could follow suit. China and Russia have been big buyers of gold. Gold is the ultimate currency, only because it's been around the longest. It's been around longer than dollars and pounds and euros and all the other fiats. But fiat currencies are only as good as the full faith and credit of the governments that print the legal tender and the other governments and worldwide countries that accept that currency. So the dollar is eroding. Now, the dollar is rallying, but it's rallying kind of in a third dimension because, even in the United States, we can see the effect of inflation is causing everything to go up, even though the dollar is very strong. So the bottom line is, the dollar feels toppish here, and if it does come off a bit, commodities will find a lot of support. But I still think commodities can rally even in a strong dollar environment and stay strong.
And you mentioned some sanctions, and we hear a lot about restrictions. What do you make of the restrictions on steel imports and their impacts recently?
Yeah, I think that's all important. Look, markets reflect the global economic and the geopolitical landscapes. Okay, so all of these tariffs and wars and skirmishes and disagreements, they impact the geopolitical landscape. They affect commodity prices dramatically because commodities are global, Leslie. They travel around the world. They cross borders. They're real hard assets. So I guess what I'm saying here is that with the current state of the geopolitical landscape, the global economy, and inflation at the highest level in 4 decades, political divisiveness, even within countries, within Europe, within the United States, this is a time of a lot of volatility, and this is a time where currency values, because faith is declining, are going down in general as an asset class, and commodity prices are benefiting. There's one other factor that I didn't cover, and that's, listen, I'm an old man. I was born in 1959. When I was born, there were 2.9 billion people on this planet. Today, it's bumping up about around 8 billion people. So the bottom line is that the demand side of the equation for commodities is increasing, is ever growing, and demand, and supplies are difficult. And we're in a very difficult position as the Fed faces supply side problems that are fueling inflation. Look, with Russia retaliating against the West, with the breadbasket of Europe on fire, with 8 billion people, the bottom line is that there's not enough commodities to really meet global demand. And where there are, as you mentioned, the steel problems, the tariffs, the trade problems, that's all interfering with the flow of goods around the world. So all of these problems create supply side problems, which are far beyond the reach of the central banks. Interest rate policy cannot cure that. Only political negotiations can cure those supply side problems, which are fueling higher raw material prices.
Andy, you said it well. We thank you so much for joining us today.
My pleasure. Thanks, Leslie. Look forward to talking again.
Check out Andrew Hecht's analysis at seekingalpha.com. Joining us next is Kim Kahn with our Catalyst Watch. Hi, Kim. Tell us what you have on the next agenda.
Well, first, I just look quickly back at our Twitter poll results when we ask you to choose which mega cap you thought was going to do best in 2023. Given the results we've seen, maybe it's the best of a bad bunch, but Alphabet definitely the favorite with our respondents, edging out Microsoft, with Apple and Meta trailing pretty far behind. And next week, it's just three big words: Fed, Fed, Fed. Everything's going to be watching the FOMC. 75 basis points still priced in, 90% chance, but everybody's talking about, is this pivot for real this time? Are they going to start talking about, as the Wall Street Journal suggested, smaller rate hikes going forward? Right now, there's about a 60% chance of a December hike of 50 basis points going down from 75. We'll see how that stays once Powell has his press conference. But overall, there's hope for a dovish tilt, and we'll see if the pivot is for real. That's going to be our Twitter poll question coming up for next week, too.
As always, we appreciate your insights, Kim. Thanks for joining us to learn about the latest market news and ideas. Check out more at seekingalpha.com and give us a like, share, and feedback on social media.